Welcome to Get Started Investing, a podcast where we help you learn to invest in 15 minutes or less. Each episode, we take one real-world business story and apply a key investing lesson to help you build your investor toolkit. If you're joining us for the very first time, welcome. We strongly recommend that you scroll up and start at episode 1. While we are licensed, we are not aware of your personal circumstances. All information on this show is for education and entertainment purposes. Any advice is general advice only. With that said, let's crack on. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Good to be here.
Yes.
Back for another week.
Back for another week. Bit of a shaky start there. But anyway.
That's right. We'll edit it up. It will sound perfect. It will be great.
Oh.
But look, we're here today to talk about a particularly Australian news story, but I think the lessons for it are global, because wherever you're listening in the world, chances are you've got some form of government-sponsored retirement account.
Yeah.
401k over in the US. Can't remember what it's called in the UK. Superannuation here. The government want us to save for retirement, essentially, and we are seeing more and more competition in that space.
Yep.
And the biggest asset manager in the world, the second biggest asset manager in the world has taken a big step here in Australia, and that's what we want to unpack today.
Yes.
Vanguard have launched their own superannuation fund.
They have. In the UK, they're pension funds.
Makes sense.
Yes.
What are they in Canada?
Pension funds. I'm pretty sure they are.
Yeah, I think so. Canadian pension funds
Canadian
just
pensions.
have stupid amounts of money.
Yeah.
Must
so
be
pension,
nice.
401, superannuation. There's something wherever you are.
Yeah.
In the major
or if
economies
there's
around
not,
the world.
your investment account.
Yes. So yes, Vanguard are into super. So it started 3 years ago, Ren, when they decided to give back about $100 billion in funds to the superannuation funds.
Yeah, they were a fund manager for super funds.
Yep.
And they said, take your money back, we're going to do it ourselves.
That was 3 years ago. It was big news. We thought, wow, it's going to happen. And it's taken this long for them to launch their own.
And just put that number in perspective, they gave back $100 billion. Do the quick maths on that. Let's say, maybe they were charging 10 basis points because their fees were probably lower at that scale to those institutional managers. 10 basis points on $100 billion is $100 million in annual fees. Even if it was 1 basis point, 0.01%, that's $10 million in annual fees that Vanguard Australia gave up.
Yeah.
They gave back.
Yeah.
So you'd expect whatever super offering they came out with, they expected to at least make $100 million from a year.
Yeah.
I mean, that's the simple back of the envelope maths.
It is the simple, and it's a ballsy move, I guess.
So that put the industry on notice. Everyone was like, Vanguard have 11 trillion Aussie dollars under management.
Yeah.
They're big.
Yeah.
They're giving 100 billion Aussie back.
Yeah.
They're going to take a big swing here. 3 years later, they've taken their swing. Thoughts?
Well, I mean, it's a massive market, superannuation, and it's only going to grow. So it made sense for me at the time.
But that
logic still makes sense.
But that logic holds if they were just managing for other super funds as well.
Yeah, but as we can see, they're probably going to make
you reckon?
more money.
I reckon the swing was kind of a fizzle.
Do you think so?
That's not the analogy. Doesn't really
well, anyway, so they've come out with a product, and the management fee for the product is 0.58%.
For most options.
For most of the options, yeah.
Okay. So that sounds reasonable.
Yeah, so we plugged it into the ATO website where you can compare fees. But it was there is some warning. So when you put Vanguard against, and the website is called the ATO Your Super website, it allows you to compare fees. When you put it in, it does kind of look cheap.
Yeah.
Which is good.
But
the
ATO website is a little, not misleading, just a little incomplete.
Yes.
And it doesn't really compare apples to apples. The Vanguard option is an index option, and a lot of the ATO options that what they're comparing aren't. If you put a Vanguard index option against a Host Plus or Australian Super index option, it actually isn't as cheap.
No.
There are cheaper options out there. And if that jargon doesn't make sense, we'll get to it. But before then, we've actually found an epic resource that does the job of comparing fees, apples for apples. It's from the Reddit subreddit Oz Finance. So hat tip to those guys. We are standing on your shoulders in this episode. But we will share the link to that in the Equity Mates forum. So if you want to actually see the apples for apples comparison, head over to the Equity Mates forum. The link will be there.
Yes. So, Ren, this leads us to the lesson because this did get us thinking about fees. Vanguard, position themselves as one of the lowest cost ETF providers in the market, and you would have thought that when they come into the super game, they position themselves similarly. But when we had a look at some of the super funds that are out there, there are cheaper options, and it got us to the lesson that fees do matter. We know that. We say we hate fees.
Yes.
And returns net of fees matter more.
Yeah. Not but.
But.
Yeah. I guess that's why fees matter, because fees eat away at your return. So when we say we hate fees, it's because it lowers your return. And so really what really matters is returns net of fees. And we'll get to that. But we tweeted this out a couple of years ago. I just had a search of Twitter to find it because I think it best exemplifies why fees matter. If you had invested $1,000 in Warren Buffett's Berkshire Hathaway in 1965, when it started, by 2019, you would have $27 million. Not bad.
Yeah.
If Warren Buffett charged a 1% management fee, that $27 million would be $25 million. If Buffett charged a 2% management fee, that $27 million would be $9 million. So you lose 2/3 of your return. And if Warren Buffett charged the traditional 2% management fee and 20% performance fee, which is like standard hedge fund, well, in the past, the old hedge fund fee structure, you would have $6.5 million. Small differences in fees can make a big difference in your return. And so that's why we hate fees, because it affects your returns. So then the question is, when we're thinking about retirement accounts, when we're thinking about super, how do we assess fees and judge it against the potential return? So Bryce, before the break, we were talking about Vanguard's entrance into the superannuation industry, into the retirement account industry, and the fees, because that was really the focus of the announcement. At first glance, it looked like it was potentially cheaper. At second look, it actually doesn't look that price competitive on fees. But really, the conversation on fees is only half the conversation. And we've pulled out an example that really illustrates why returns net of fees is more important than just looking at fees alone. Now, we have chosen Australian Super to compare because is it Australia's biggest super fund?
One of, yeah.
It's kind of like the one you think of. It's really, the name is
Host Plus is the one I always think of.
Really?
Yeah.
You love Barefoot Investor?
Well, it's because I was with them for ages.
Because Barefoot Investor told you to?
No, because it was the default one that I got put in. The very first thing.
I think that's the cheapest one if you just go their indexed option.
Yeah,
I believe.
Well,
yeah. So we're comparing it. So we had a look at Vanguard's high growth superannuation fund, and it is basically exactly the same as the Vanguard Diversified High Growth ETF, VDHG. People in the FIRE community would be familiar with it.
Yeah.
To give you an idea of just how similar it is, we looked at the asset allocations for both of them. Australian shares, 36%. International shares, 26%.
This is for the superannuation fund?
Well, this is for both.
Yeah.
International shares hedged, 16%. Global bonds, 7%. International shares small companies, 6.5%. Emerging markets, 5%. Fixed interest, 3%. The asset allocation in the ETF and the superannuation fund are the same. So we can use VDHG, the ETF, and look at their returns and their returns net of fees and compare it to Australian Super to really illustrate the point of why fees are only half the story.
Yeah.
So talk to me about the returns of Australian Super and VDHG.
So if VDHG's only been around for a few years, so we don't have a huge comparison, but nonetheless we can have a look. So gross, so this is not net of fees, VDHG has returned 3.62% per annum. When you then strip away fees, you have a return of 3.34%. Or
Net of
include fees, I should say.
We
Once you take out the impact of fees.
Yeah, so 3.34% per annum over the last 3 years.
Yeah, so that's for VDHG, which is the Vanguard Diversified High Growth, which is representative, I guess, of the super fund as well. As Ren just demonstrated, it's pretty much exactly the same. If you then look at the Australian Super index comparison, their high growth fund returned 6.32% per annum. It's a bit unclear whether or not that's gross, but you would assume it would be.
Yeah. You generally assume if they don't say net of fees, it's not
gross.
net of fees. Yeah.
Then their balanced option returned 5.59% per annum. So both their growth and balanced options have returned almost double the VDHG over the same period of time.
And so even if you netted fees out of Australian Super, your return net of fees is higher because it's actively managed, the asset allocation is different. And I think that is the key takeaway. That fees are only half the story, but your return net of fees matters more. Like you should be okay with paying more fees if your return still does better than that.
If the cash in your back pocket at the end of the day
that's all that matters in your retirement account. And
Yes.
so a lot of, I think, Reddit were onto this straight away. Like some of the commentary on Reddit was pretty scathing of this offering. We're just surprised at how lackluster it was, I think. Because, like if you can get a better return elsewhere, that's the main thing.
Yeah. So while we hate fees, it's always with the lens of keeping in mind net return is the important thing that you're thinking about at the end of the day. You're looking at long-term performance of the manager, long-term performance of the index, and then making an assessment against the fees, passive v active, and that balance between the two.
So I think my concluding thought on this whole thing is when you're thinking about retirement accounts these days, you have two options. You have passive, where you just take the market average return, or you have active, where you pay more and you ask a fund manager to try and beat the average market return. To get you more, you pay more, but you try and get more as a result. If you're happy with passive, if you believe that over the long term, active managers can't outperform the market average, they can't outperform the index, then the challenge for Vanguard is that there are cheaper options to do that. There are cheaper passive indexing options available in Australia if that's the road you want to go down. And then if you want active management, if you want to try and beat the index, your fees will be higher than what Vanguard offer, but you'd expect better returns. And we just saw in that Australian Super example that there are funds out there that do deliver better returns. So it kind of feels like Vanguard's in no man's land.
It does. It's surprising. They haven't gone as hard as we would have thought with the scale that they've got. You'd think they could offset some costs. Anyway, maybe we could get someone from Vanguard on to come and talk.
Probably
about
not after everything we've just said.
Well, I'm sure they'd love to. I'm sure they'd love to explain what's going on. Maybe we'll see in a few years' time that it does come down once some funds come in, or whatever it may be.
And but I guess that's been the Vanguard story. Their mutual fund structure, which is probably more relevant in the US, is that like as more money flows in, the fees get reduced because the company, at least I think the US company, is owned by the owners of the fund. Yeah.
Anyway, so that's the story. Vanguard are into super. Check it out. We'll share the link that Ren was talking about that compares a lot of the funds here in Australia. Anyway, I'm sure if you're listening overseas, there's some 401 or pension comparisons. But the main thing is to consider A, the fees that you're paying, but B, then if it's a passive or active approach and weighing up the balance between the fees and then the net return at the end of the day. So keep that in mind. But Ren, that's the lesson for today. We'll pick it up next week.
Sounds good.